Long-term investors will experience a number of market downturns over the course of their lives, which can be triggered by everything from natural disasters to political turmoil. So if you're investing for retirement or another long-term financial goal, you need to know how to weather a market correction without being thrown off track. Start by assessing what type of downturn we are experiencing. You may hear a variety of terms used to describe a market downturn. A drop in average stock prices of at least 5% and less than 10% is known as a pullback or a dip. A drop of at least 10% but less than 20% is called a correction. And a drop of 20% or more is called a bear market or a crash. Once prices return to the most recent high, the market is said to have recovered. On average, crashes can take longer to recover than corrections do. Investors can't know for certain that a correction isn't a crash until it's over. For example, if stock prices dropped by 14%, the trend could reverse course from there and return to the market when it's at its previous peak. On the other hand, prices could continue to fall, eventually dropping by 20% or more, resulting in a crash. So how should you invest during a downturn? The stock markets are notoriously difficult to predict, which is why market timing is generally a bad idea. For example, it might sound great to pull your money out at the top and redeploy it at the bottom, but when will those events occur? Historically, the best thing to do during a downturn has been to sit tight and ride it out as long as your portfolio is allocated to your risk tolerance. That's because historically corrections have always been followed by recoveries, and you can only benefit from the recovery if you hold on to your investments. We recognize that keeping cool is easier said than done. At times, it can be helpful to tune out the endless market coverage, which can fuel anxiety and lead to poor financial decisions in the short term. Market downturns represent a great time to speak with your financial advisor. They can offer a third-party perspective and put things into historical perspective and make certain your actions are aligned with your personal goals. If seeing your assets go into the red is truly causing you stress, you might have a lower risk tolerance than what you originally believed. Your financial advisor can help you reassess your asset allocation and potentially tweak it to better fit your needs. Market downturns are an unfavorable fact of long-term investing, and a sound financial plan takes them into account. If you've already got an investment plan that reflects your unique situation, then the best thing to do during a downturn, based on historical performance of the stock market, is to remain committed to your plan. If you would like to discuss your financial plan and your risk tolerance with a financial advisor, give us a call today at 602-343-9301 or visit us at strategyfinancialgroup.com and click on the orange Schedule Meeting button. Thanks for joining me.